is when you purchase a share or a stock of the company, you want to understand as to how much of the company's profits is that share gonna net you. And so to go into the calculations, the formula is basically net income minus the preferred share or a common share over a period ending of that outstanding share. So an example would be if you want to look for the EPS of, I'll just use Tesla for an example. You would look at the fiscal year, the whole year, and you look at the outstanding um, shares minus that net income, and that would give you a number for the EPS of the company. So I have some notes here written down. So essentially, um, when you're using the EPS, there are little, let's say, hiccups that might come up, which could offset numbers by a little bit. And some of these little hiccups, so they call them extraordinary items, could be the company could present a sudden loss, or let's say maybe the building caught on fire, there's a major theft, then that will affect the numbers of the company. So you may not get an accurate number for the EPS at that time. So those are little things which you would want to really look into. And so going forward, I am going to also leave a link after this meeting, and it's going to give you the actual visuals for the equations which I'm going over, so forth. Okay. So basically now, there are two types of the EPS. There's the basic EPS, and there's a diluted EPS. So the basic EPS is sort of like what it says. It's very basic. It doesn't involve um, the issue of shares. There could be dividends involved, and it's not really going to take into those uh, assets into the basic number for the EPS, where the diluted EPS will give you a much more accurate number as to what the actual EPS really is. And so to give a good example here, I'm going to use example, let's say Ford. So Ford has a net income of $7.8 billion, and they have no dividends, and their outstanding shares, the amount of shares which are on the market, are 300, let's say 4 billion shares. So you want to take that net income, which would be 7.6 billion, and you want to take the common outstanding shares which are on the market, and that's going to be 4 billion. You're going to divide those two, and it's going to give you the EPS for Ford, and this is the basic one. So that number would be around 1.9, meaning for every share that you have purchased with Ford, you will get $1.9 of profit from what the company makes. Okay. So when you look at this number and you get more comfortable in doing these calculations, it's going to help you to understand that when you purchase this stock, how much of this stock do I have to buy to get $1 or more profit from the company? Okay. Another example to help sum this up was Nvidia. They're a graphic cards company, and their total profits were $3 billion. And they have outstanding shares of just 600 million. We'll put it that way. So you're going to take those two numbers, the net profit, which is the 3 billion, and you want to take the outstanding shares. These are shares that are on the market, and at the time it's 600 million, and you want to divide those two numbers. So when you divide these two numbers, now you get $5.09 or 10 cents. So that means for every share of Nvidia you buy, you're going to get $5.10 worth of profit from them. So that's a much better number than Ford. But before we jump into that, we want to say, wait a second. Now, when you use the EPS number, you want to use it within the industry itself. So you don't want to be looking at Tesla and looking at Nvidia and looking at Walmart. They're in different industries. So when you're making your comparisons, they're not going to be very accurate to what you want because they're operating out of different proportions. So it's really hard to get a baseline if you're not comparing similar companies in similar industries. Okay. So let's further go down here. So one thing which you want to take into mind with the EPS, there's also something called the earnings for the profit, or so forth. Let me get the exact wording for it. The PE ratio, which is, yes, earnings per share. So this really ties into the EPS because essentially what you're looking at is the value of the company, right? How much are you willing to spend to get that dollar or more of the company? And one good example I like to use is when you go to a grocery store, you're basically in the stock market. There's a whole bunch of products on the shelf which you can choose to purchase. And so you can go to the soap aisle and you see this soap, which is $2. And for that $2 soap, you're getting 100 millimeters of liquid, where there's one which is $5 and it's giving you 300 milliliters. So when you just look at the stock price of a company, you will make bad decisions because you're going to say, oh, this is cheaper. No, this is $8. This is $10. I'll go with this. But that's not necessarily the case. When you look at the value of the company, and going back to the dish soap, one which is $2 and it's giving you 100 milligrams, whereas one which is $5 and give you 300 milligrams. To get that 300 milligrams, you'd have to spend $6 to get what that $5 was giving you. So now you start to see that it's actually cheaper. So when you take the same principle and you want to start applying it to your investments, you're going to make sound decisions because now you're looking at it to say, this company is trading at, let's say, $20, and this company B, which is trading at $30. But now you're going to say, let me use the EPS ratio to figure out exactly which is going to give me more value for your dollar. And that's what you want to be thinking about when you're thinking long term. You want to have your money working for you as best as possible. So you want to look at this to say, with this EPS here, which am I going to get better? Where am I going to get most of my money from? Right? And when you make that decision, then you're going to say, you're going to be able to allot more money. You're going to make better choices. You're going to understand what the market is willing to pay to get that value of that company. And that's one thing which is something which probably is overlooked at times, is looking at what is the market willing to pay and what are you willing to invest to get $1 per share back from the company. So it's a great indicator to see if the company is overvalued or undervalued. And to help you understand that, let's see here. Let me get these notes here. Okay, so for the PE ratio, which is the price per share over the PE ratio is a share price, so that's the current price of the stock on the market, and you're looking at the earnings per share, which is the PES ratio. So once you get this ratio, what's going to happen is, on average, the S&P 500 usually ranges between 15 and 13 for a PE ratio. So when you're looking at stocks, you want to sort of get stocks that fall in between this number of 13 to 15 for the PE ratio. When the ratio is higher than 15, then you're starting to look at overvalued. And what this basically is saying is that the market is willing to pay 13 to 15 times the actual value of the stock. So that's considered to be normal. But once it goes beyond that, then you're starting to look at it could be overvalued, right? Now, if it's under that, then the stock is undervalued. So these are good indicators, but you shouldn't take them at face value. Once you're looking at a company, let's say you do the PE ratio, and on most platforms, they usually do tell you the PE ratio. It's usually with the 52-week high, lows. It tells you all that information right there. So once you look at this PE ratio, you want to be working within this range. 13 to 15 is pretty good. If it's a bit higher, that may not be the case as bad, but you just want to start comparing it to its peers and take a deeper look into it to see, where's the value. If you invest now, are you getting good value or are you losing value? With the number of the PE ratio, if it goes under 13, then it's starting to be undervalued, which is a good thing, which is what you're looking for. But you still want to apply the same mentality, is to look through it and make sure that you compare it with his other peers to make sure that, it could be at 9, but then his peers are trading around a PE ratio of 8. So compared to his peers, it's overvalued. But if you look at a whole market, it could be undervalued. So you want to really make sure you're looking at the company and comparing it to its peers or its competition to understand if you're getting a good value for your money or not. When you are investing, one of the key things, and this sort of applies with the PE ratio, is that you want to have your money really working on your behalf, right? You want to really think like that, and you want to apply this to your daily activities, right? So when you come into investing, you want to have this strategy, and by using these ratios, these will help you to make an informed decision to get to that goal of yours. So with the EPS ratio and the calculations, what you're really looking for here is a number which you have set for yourself, right? And so if you're going by what the market is dictating, then it will throw you off, because a market could say this ratio is great for this company. But you really want to take that time to look into the company's financials, because this is where the EPS numbers are coming from the company's financials. So if someone were to just say, you know what, hey, this is your bank account, has this money in it and so forth, and you're saying, wait a second, how did this get here? Why is this missing? You're going to look into it, right? That's the same mentality you want to have when you look into a stock. You want to say, okay, this guy said this number, but go look into it for yourself. Understand what the company's doing, the financial health, because the EPS and the PE ratio are great indicators to tell you the health of the company, the financial health. And that's really where you want to make these decisions when you're doing long-term investments. You want to make sure that the company is making money and there's good growth potential in it, and who's managing the company won't do silly things with the money, right? There's many times where, as you see right now, this market has been crazy with GameSpot and these other ones that are going all over the place. And I sometimes look at the ratios and the numbers, and some of these numbers in the negative, meaning they're losing money and people are buying the stock crazy. And I'm like, I don't know. I mean, put your hand up if you want to buy a company that's losing money, right? I didn't think so. I'm not doing that. But, they're following that market and they're not looking at the financial health of the actual company to make a sound decision. So if you're gonna be doing short term, you can, yes, go with the market if that's your goal to do so. But if you're doing long term, and as I mentioned, Warren Buffett, I always look up to him. It's very true. You do long term. One of the key things he's always looking at is the earnings per share ratio, because that's a great indicator, and the PE ratio. Those are also great indicators for how much value people are willing to buy over the market price to actually earn or have a piece of the company per se. I think someone had a hand up there, Bryce.
Yeah, there is a question from Richard. Richard, if you
Yep.
can turn on your mic.
Good evening, everyone. Thank you for doing this again. I'm quite thankful for the information. Could you maybe speak a little to um, your thought process on long-term investments where the price to earnings ratio is extremely high um, because the company is losing money, but it is a newer company, so the earnings per share is in the negative, which you can't even really have a true price to earnings because they're not earning any money yet. Um, but when they finally get in the earning money portion, and then their price to earnings is very high, but the long term growth potential is good for that company. Could you maybe speak a little bit to how you go about valuing those companies and whether you want to invest in them? I hope that was clear.
Yes, yes, absolutely. Great question. So going forward, that's excellent. Where, like Richard said, for some companies, um, they could be new to the market, so they won't have enough information for the PE ratios or the earning per shares. And so, as a value investor and long term, um, I look at the management of the company, the CEO, the CFO, where are they coming from? What's their experience? And sort of like when you go to a job, they'll look at your history before they make a choice. And so that's my approach. I look at that, and then from the management, I look at the company itself. Say, what are they up to? What are their competitors? What's their product? Do they have a good moat, meaning, their products here, and it's so well designed and thought out that competitors can't really come and take their product as easily. It's very unique. So with that case, I look at that, and then the last case being, I look at, who is doing something similar to this company that maybe may have been on the market for a year or so. So then I can start gauging to say, okay, this is what their price is. I can go back in history to say, let's see what their price was at that time, but also consider any world events happening, because that also affects. And then I start coming to my decision from that point forward to say, I feel like from what this company is doing, they have a great potential, and I feel this stock will be worth X amount of dollars in a year. So then I would say right now I feel, from what they're doing and the amount of outstanding shares or so is available, I feel like it could be worth, let's say, $15. Right now it could be maybe 17. So like Warren Buffett is, and I really believe in that because it works, I just sit down and wait. Right? There's no need to rush to put money on the market. You can leave money in the bank and be smart about it and put on the market, and you'd make more money than just putting on the market just for the fear of missing out. I hope that answers your question, Richard.
It helps. Thank you.
No problem.
There is a little thing I wanted to add. So I just shared my screen right now, and I just wanted to basically show a little bit how it is if you are actually trying to find some stocks that are great, right? According to like what Josh just talked about, right? So usually I always recommend people to go on Finviz. There is a really great thing that is the screener right here that you can just screen different stocks according to, right? So basically, I'm just gonna go quickly over it so you guys can have an idea of how it works. So I'm usually going into software and application only because this is mostly what I'm looking at when I'm looking in the market, and I'm going for often like big companies. So let's say over 500,000 transactions, which is quite a lot, right? So after, if you click under fundamental here, you can see that there is everything that just mentioned. So there is the PE ratio right here that you can filter according to. So if you want to go under a number or over a number, you can just filter by that. You can also go for EPS growth. I usually use that. I find that it's really helpful because you want to have like companies that are growing over every quarters, right? So every time they are making like better returns. So you actually want to look into those companies. So you can put any filters by that. Just go for something really high, right? Just that has a great earning per share ratio. And at the same time, it's really great for like stability of the company, right? So for instance, here you can see, yeah, you can see that some of the stocks, like maybe you know some DocuSign that was doing really well during the pandemic, especially things like McAfee, which is the antivirus, Eventbrite. Um, so like, yeah, there is like different companies, and after that, based on that, you can start looking at like what they are doing more into details, right? So if you want to add some more technical indicators or something, at least it gives you a good idea of like companies that are actually doing great already, right? So
Mhm.
I just
And
wanted to add that.
there's one question they asked, what's a good EPS ratio? And that really depends on, as mentioned, the performance of the company. It's comparable when you're using the EPS ratio. So you want to, as mentioned, you want to have companies which are very similar operating in the same industry, and you want to compare them. Otherwise, if you're not comparing it to anything, any number could be pretty decent in EPS if you have no baseline for it. So if there's a company which you're looking for, going back to research it, but also look into other companies that are doing things similar and look at their EPS ratios, their numbers, and then you will start to see which is a better number for you.
Mm.
So you want a higher number, by the way. No problem.
I would like to mention also something. Just looking at Finviz, there is also an option to see the projected earning per share, projected EPS growth for the next coming 5 years, for the next 5 years. So that can also give you an idea of how analysts have analyzed the company, and based on what the company has provided, what is it that they are looking at? You know, if you see that the next coming years they have their EPS growth is decreasing, then that tells you that in the future, that company might not be a really good one for a long-term investment. But if you see that for the next years, next 5 years, the earning, EPS growth shows a really good growth or is predicted to grow, then that can tell you that that is a really good investment for long term.
I think we had a question there, Bryce.
Sorry, which question was it?
I think someone put a question in the chat. I didn't catch it.
Yeah, there is one. What is the EPS data? Basically, like, yeah, Josh just mentioned it. So during the earlier in the meeting. Anyways, we're gonna share the recording tomorrow, so you're gonna be able to see that.
But in short, the EPS is a earnings per share. So as I mentioned, trying to keep it as simple as possible. It's how much money from the share you will get when you purchase it, and you will get that value from the company. So if you buy a Tesla, let's say Tesla is $700, let's say, and you do the earnings per share and realize for you to get $1 from Tesla, you have to buy $800 worth of Tesla. Then that means it's way overvalued, right? You have to basically buy a share and a half, let's say, to get $1 of the company's profit. So that's basically what the earnings per share is telling you, is how much of the company's profit you will be receiving per share that you own.
Yeah. I also have a question for you, Josh. Does the dividend, the pay when they pay the dividend, does it actually affect the EPS?
Yes, it does, and that goes more into the complicated EPS number, which it will give you more of an accurate number, and that's when you're really adding in losses, expenses, everything's put in there, and it gives you the very accurate number. So you usually for those numbers, you want to go to the balance sheet of the company and just go through all their info, and they'll give you like almost 100% for the EPS. But for most investors or so, when they're looking at it, that number is fairly close. It may be off by some, but the EPS that they give you, the basic, it won't be too far off if you put in a whole bunch of their calculations or something.
Okay. Thank you.
Richard has another question. Richard, you can turn on your microphone.
Thanks. That was a great question, just previous that I hadn't thought of. So just to clarify, the dividend payout, the yield, that is not included in the normal standard EPS that we find on different stock apps for looking up companies. It is not included.
Usually that's the case, yes.
Thank
Now,
you.
some of them may have a little asterisk or something, and stating or so forth, but usually it's just they do the basic EPS for most apps.
And so the dividend, as a normal layperson looking at that, the EPS that's listed, the dividend is subtracted or minus from that EPS, or is it on top of the EPS?
Yes, it would be minus.
Thank you so much.
No problem.
Okay, there is another question from Mami. So she's asking if I want to screen for currently oversold, cheap, but good companies, what filters are you going to use for that?
You want to use the PE ratio. So you want to use a PE ratio, and you want to have, if you're looking for under, usually you want a number that's under 13. then it's on the undervalued. But as mentioned before, is you also want to do a comparison to other companies within the same industry, because it can be saying it's 12, but compared to the other companies within that industry, they could have a PE ratio of 10. So then that will now be expensive. So when you find the company that you like, always pull in a few more so you get a baseline comparison. And that will really help you out in making a better decision.
So yeah, I would say to if you go on Finviz to really try them, right? So I don't know if you can see my screen, but I'm just playing with some. So with the P ratio, now I'm under 30, under 15. It's a bit like stringent, but you can see that there is still some results, right? If I'm going under that, then there might have no results. So yeah, I would like, as Josh just mentioned, so like low is kind of under 15, right? So yeah, you can totally play with that. I think it's a great tool.
But then again, even going back to what you just said there, is that you can maybe put that number to 17, and it may seem a bit high, but as you look at other companies within that field, that 17 could be pretty cheap compared to other ones that could be at 20, 23. So it's very you have to really compare when you're using these ratios, when you're using the balance sheets of the company, like you have to put the time into it because it will take time to do the calculations, to do the numbers, but the reward is you will get a better deal, right? And that's going back to Warren Buffett. He's like, just be patient, do the work, and he goes, it pays off.
Mhm. You see that question, Josh?
I sort of read it. Could you get that one for me?
So yeah, so there is another question that is the low PE ratio tells you what's cheap, but how to balance with filters that tell you good stocks.
The low PE ratio, um, it indicates how much the market is willing to pay for the stock, like over it. So if the stock is $8 and has a PE ratio of $15 or 15, sorry, then it means the market is willing to pay 15 times the actual stock value, right? So right now, basically what it's saying is that stock is really worth $1, let's say, but it's at $5,
Mm.
but it's acceptable. They'll take it, right?
Oh,
But if
mm,
now that stock was $5 and the PE ratio was $30, that's way overvalued, right? So the
mm,
PE ratio is helping you to distinguish the value of what the market is willing to pay. And so the market usually will pay 13 to 15 is a good number they want to look for. It doesn't mean it's gonna be on the market, but once they see those come in, the seasoned investors will look into it
mm.
because they know those are a good number. But
And another thing to look at oversold. So last time we with Emmanuel we talked about the RSI, right, which is a really great indicator if you want to look for oversold and overbought stocks. So it's a filter that sometimes like I would use personally. So like put something oversold, look at all the stocks that are oversold, and after that I'm gonna look for the growth, right? So basically those that are growing but just having a decrease in momentum, right? So that's also a good way.
Which also means that you can use a combination of both. You have that possibility with Finviz using the RSI technical analysis to filter your stocks, and you can also use fundamental analysis to filter the stocks.
Hmm. Yeah, I'm just gonna show it quickly. So if you go on your screen, you can just go same thing. If you go under technical, here you should have the RSI. So you can just go for oversold stocks. Usually, if you add many indicators, it's better to go with like something that is not too tough to in terms of like oversold. So I would put something like 40 that can give me an idea. And again, I'm gonna look for like stocks, maybe like over 500,000 volume. And after that, I'm gonna put the EPS. So if I want to have something with like high EPS, so then I have like those stocks that are all oversold right now, but that still have really like good growth in the last year. Mhm.
Mhm. Yeah, so going back to what we're saying, it's the EPS and the PE ratios are really understanding how much money, you know, you're going to be getting back from the company's profit, and you're going to be understanding, how much the market is willing to pay, and that's the PE ratio, how much the market is willing to pay for that stock. So when you see that number of 20 or 40, it means the market is basically paying 40 times the value of that stock, right? Like if you look at like the GameSpot, you would see their P ratio probably is like 300, which is it's way over the price, right? So you wouldn't want to purchase that if you're a value investor. You would stay clear from that because that in your head means there's no value to you. All right, I guess that hopefully answers your questions, and I'm gonna be leaving some useful information in the group just a few minutes afterwards to really help you guys out, and definitely shoot us some questions if you have any. Always ask questions so we can help you the best we can.
All right, thank you very much, Josh. And guys, if you have any questions to Josh in the group, anytime you can just ask him. So yeah, thanks again. Thanks Emmanuel for taking part of it. So have a great evening, everyone.
Mhm. Yeah, we have.
Before we go,
Oh yeah,
maybe if anybody has questions about like the game stock or the craziness going in the market, they can ask right now, and we can try to give some advice or share some ideas.
yeah, I think that's a great idea. So like, let's just stop the meeting now. So everyone that wants to join, maybe we can just talk about GameStop. I know that Emmanuel, you have some good insights about it. So
Yeah.
yeah,
So yeah, basically what is going on in the market is actually just a little bit madness. In a point that I sent it that last time in the group. The fact is that so there are some analysis. There are some platforms where you can see how a stock is being traded. Like you can see how much is being sold or how many people are selling that particular stock, and you can see if they're actually retail trader or institutions. So what happened last time is that people noticed that a lot of institutions were selling GameStop, GameStop, and the fact that they are selling GameStop, what actually happens is that when they're selling it, when they wanna buy it, then so when you're selling a stock, when you are selling a stock or an option, what you do is actually it's like you are borrowing a stock from the broker who has the stock. You're telling him, "Hey, can I borrow this stock and sell it right now? But I will bring you back your stock later." And what that means is that you borrow it, you sell it, but then you are expecting for the price to go down. And when it goes down, you're going to buy it again at a lower price and sell it and give it back to the broker. But then when people understood or people noticed that there were so many short position on that particular stock, they understood also how much the demand gonna be at the end, because when everybody wanna get out of those short position, they're gonna be buying a lot. So if you position yourself before those buys, you will be in a good spot, and when they are buying, they will increase the price. By buying, they will increase the price. So what happened is that the retail traders, they position themselves on buying position on the buying side, waiting for institutions to buy back the stocks. But the problem is that they're not selling. So institutions are trying to buy, but they are not selling. So they are holding their position, and they're telling everybody, any other retail investor, to buy as much as they can so that they can increase the price, because the institution have not reached or did not reach their target yet, and they're in negative position right now. Their portfolio is in negative. So the thing is, this is actually really madness, because if nobody is selling, the price will just keep increasing. And at the end of the day, when people will have enough gain, they will start selling. And what will happen, what I'm actually very scared of, is that when everybody starts selling, first of all, because this stock is going so high, it's going so high, the institution or hedge funds, they're having they're in a position where they have to sell other stocks to cover their losses in this position. And by selling other stocks to have more liquidity, that itself is putting the market to go in negative already. Another thing that's going to happen after this is that when everybody will start selling this, when they have enough profit, but they're going to start selling this. And as you know, this time there is a lot of algorithm. And if the algorithm sees that people are selling, it's going to start selling too. So when everybody will start selling this, I'm really afraid that it's probably gonna start another crash. I can't confirm that, but I'm thinking that might be possible, because when everybody's gonna be selling, and then those automated trading algorithms start selling too, and the market is already in the red, that will automatically launch another kind of a crash or a market correction. So
Yeah, so
yeah.
one thing to add is that interesting enough with the these frenzies, as we're seeing more of these frenzies are popping up, right? It's this GameSpot, and who knows, next week these new things keep happening. And the thing which I also look into this is that how do these things get started, first of all, right? People on these Reddit groups, or these groups of individuals, retailers, as you call them, are coming together to sort of shake the market up, right?
Yeah.
So the one thing which I find, which I say, in a way I say good for you guys, is that you guys are shaking up the big money. And just as you mentioned, the institutes try to get in, but then us retailers are ruining their game, because they have their own groups and they're saying, stick to this plan. Whereas the bigger companies, institutions, are trying to get you to move your hand, so then they win. So right now, the market is sort of in a limbo, saying, you have your retailer and you have the big guys, but the big guys can't really push the small guys so much right now. So right now, the big guys are really frustrated, because it's like you're basically making them lose at their own game. So it's interesting to see, what are they gonna have to do, and basically, they're gonna have to start accommodating, because if the retailers can continue in this mindset to say, as a group we can push and make money, if they're consistent with that, they will start pushing the market around. And it'll be interesting to see what the big guys are gonna have to do, because they're gonna have to change their tactics, in order to continue what they've been up to for these years.
Emmanuel, did you see that question in the chat? Yeah.
Maybe.
I just have a question. What's
Yeah.
your views on HCMC stock?
Sorry?
What's your views on the stock HCMC stock?
HCMC, can go
Yeah.
check.
Mhm. I heard about that
And
one.
It's
Me personally,
Heard
when I
about-
start stock, I don't look into them. I'm like, they're already going to be.
when what?
When I hear too much buzz on the stock, if you don't have it
Yeah.
before then, I said I don't bother because I
Yeah.
know it's already going to be. They're creating that hype about it, and people are getting excited, and they're just going to start buying in when a lot of them don't really know what they're buying in. They're just excited and say, "I want to join in on it," and
Yeah.
at that time, it's like there's really no value. You're paying overvalue for it, and you're paying so much more than market price. So I just don't bother with those ones.
Yeah, that's what I think too. Like most of the time, if you see like a stock going super high, a lot of time it's already too late.
Yeah.
And like you can maybe just like just like follow it by interest, but like it's too late. Like if it goes high, and the thing is that there is so much risk also related to that. So
Yeah.
if you put money in that, if it can go up 100%, it can also go down 100%, right? So like you don't really want to have that into your account unless you manage it well, right? So what I suggest for people that actually really want to jump into those random opportunities, it's just to like allow a little bit of your portfolio, like just it's like, to me it's like the lottery, right? You just
Yeah.
like let's say I would put something like $50. If it goes up 200%, well, that's great, but like if I lose, I just lose $50. It's not like something massive, but I wouldn't put too much or like really consider it. Yeah, there is a question from Richard.
Go ahead.
Thanks, Bryce. With your comments earlier about the potential correction due to the GME AMC fiasco going on right now, how much of or what percentage of your own portfolio, or anybody please speak to it, do you keep in cash so that when a market correction occurs, you're ready to buy what are good companies at lower prices? Do you have a certain percentage? Does that matter to you? Or, do you hold a certain amount in cash to take advantage of those situations?
I guess to answer that, for me especially, it comes down to, as I mentioned, having a goal and a strategy are two different things, and I feel like a lot of people confuse them and mix them up. Whereas if your goal is, and you want to have a definite goal, saying, I would like to have $100,000 in 2 years from investing my money. That's a goal. You have a timeline, you have a method to get there, and you have that final product, right? That's a goal. Now the strategy is, how am I going to get to that goal? And through that strategy, it'd be your strategy, but you might say, I get paid X amount of dollars. I want to allot this much into investing and this much into savings. So when you allot that money into the investing, now you have to structure yourself to say, I'm going to go about buying companies that are valuable, offer great value. And you're looking in, let's say, the tech industry. Now you may look, you may not find anything at the time, so you leave it alone. And you continue to put that money in there, and you continue to look. And then when something happens, you'll be ready. And that's exactly what Warren Buffett does. Money's always put away. When he sees something, he has the money because he's been stacking it away. So that's how you want to tackle things. Is keep to your strategy and don't differ from your strategy. And when the time comes, you will be ready. But if you jump on things because there's a little hype or so, when the real deal happens, you're not going to be ready.
So you have two different, I guess, portals or holdings for your cash. You have the cash that you're willing to invest on an ongoing basis, and a cash pool that is your savings to take advantage of what you see as a market drop. Am I rephrasing what you said correctly?
Well, I would say cash savings, as in put money away in an actual savings account and leave it there for a little rainy day or whatnot. You want to have that money. You don't want to put all your money into investing, right? You want to
And,
put. That's what I'm saying. If let's say you get paid $1,000, now
and
that $1,000,
what percentages do you consider?
well, see that's personal preference because this person could have this
Okay.
much debt or
Okay.
right. So that's why I don't say give a specific number. I want you to
Got
look
it.
at
Okay.
your
Okay.
personal finances and come up with something that works for you. These
Thank
are
you.
your goals. You want to do what works best for you.
In terms of percentage, for me, I usually leave at least like 40%, 40% in cash, especially because I trade options. Sometimes your options can go a little bit higher than the premium that you paid for. So I always leave a little bit more cash, like 40% in cash. But in a situation like this, I would leave a little bit more than 50%. Definitely more than 50%, leave it in cash so that when opportunities come, you can use them and grab something good.
Yeah, that's pretty good. I can also answer for myself. I'm really looking at like going into a different type of investing. So I might go into like cryptocurrencies or look at like other opportunities other than the stock market. So that's why if I feel that there is kind of a slowdown on the stock market, I'll just put most of my money somewhere else. I'm gonna still keep some positions because there is some companies that like I'm really having for long term. So even if there is a correction, it's fine, but like I would secure some of my money into yeah,
So,
other places.
so
And
I would
another
definitely
thing,
go ahead.
yeah, another thing when it comes to investing in a situation like this is that you can also invest in the volatility. One thing is for sure, the market will not be like this forever. So this is a period of a volatile market. There is a high volatility, so you can invest in that volatility. And what I mean by there is that you can right now the volatility is still going up, but as soon as we have like a peak, we get to the peak. There is a limit on the volatility. You can go up to 100%. So as soon as we reach to 180 to 100, you can buy some put or start selling, uh, shorting the volatility index. And that is for sure. You just take a long term, that is for sure the market will come down. So it's for sure when it comes down, you take your profit.
Hmm. And one thing I want to add to it is when you're getting into investing, and you're starting off, is that a part of your strategy should be how much money are you going to be investing? Meaning, when you get paid from your normal job or whatever your main income is, you want to portion it out to say, I can allot 500, 200, even if it's a $50 to invest in. And then once you put that allotted amount, let's say it's that 50 or $200, now you can break it up to say, I want to invest, you know, 50% into the stocks, and maybe you want to try crypto, so you put 50 in. So these are the strategies which you want to come up with, is having a solid plan before jumping into the market. Because if you don't do that, I guarantee later on you'll make some money, but then you go broke again. And you make some money, you go broke, and because you don't have a solid plan. So you want to make sure you understand as to how much money you're taking from your main income to invest in there and stick to that plan. And then when it's in the investment pot, you divvy it up to say, maybe I do real estate, stocks, and crypto.
Yeah, and as you mentioned, um, the money that you put in your account, you will never invest. Like, you should not invest all the money that you put in your investment account, right? So first of all, you calculate how much money of your income you're gonna send into your investment accounts, or you're gonna send into your portfolio, and then from that money you divide now how much you actually want to put in a different type of investment. One goes in equity, another in options, another in stocks, another in whatever. But always have some cash in the investment account, because, for example, you get a great opportunity, but you hear about that on the weekend. The market is closed on the weekend. You cannot send money there. But on Monday, because you already had money there waiting for you, you're gonna be able to go ahead and purchase your security or use the opportunity. You know?
Oh, there is a little thing for Emmanuel, so about investing in the volatility. Maybe next time we can have a session about it. That would be great. I think that's a great subject. So
We did. We can look into. We did another session when we talked about how to trade the action in the U.S. It's kind of the same mentality. We talked about the TVIX and VIX. That's the VIX is for the volatility, the options of the volatility, and TVIX is like the stock of the volatility.
mhm. Okay, that's good. Well, thank you, guys. I think it's really interesting to have those discussions. Thanks, Emmanuel, for also bringing GameStop as well. So, yeah, I think we should do something about like investing in volatility as well. Maybe like just something else, and because it's great. Like sometimes there is so many like great things we see, like those 100%, 200% in a day. So like it's great to know what do we do with that if we want to act on it, right? So. Yeah, thank you very much,
Yeah.
guys. Thanks, Josh. Thanks, Emmanuel, for all of that. Mami, I'm just gonna like send you. There is our YouTube channel, so I'm gonna send you the video that we talked about for during the U.S. election, so you might have an idea of what it is. But yeah, thanks, guys, and everyone have a great evening.
Thank you. Have a great evening,
Thanks
guys.
everyone for coming.
Enjoy.
Thank you all. Appreciate you sharing your knowledge.
No problem.
It's like, is Gianna still?
Uh,
Yeah, Gianna still around?
I think she just left.
She okay? Because yeah, I could have go over Pfizer, but
Fine.
Mommy left as well. I was supposed to send the. Oh yeah, she's saw you. Right. I'm just gonna share the channel.
Okay. But yeah, man, there will be so many people will. If people are not very careful with this